Hi, Sam here, standing in for Shingerai, and here's another Berkshire portfolio update. It's been another risk-off week in global markets, with our portfolios performing between minus 1.09% and minus 4.68%, with 2 out of the 10 portfolios outperforming benchmark. When we look at other reasons why this has happened this week, we see continuing draconian measures to contain COVID-19 in China. We see that the Ukraine crisis is still inflicting considerable pain within European markets, in part now due to gas supply restrictions. Furthermore, we have been seeing responses to the central bank committees changing interest rates last week. When we look at our individual funds for the week, we see that we have had considerable performance from our corporate investment grade holdings, with Vanguard US Corporate Bond returning 1.27% and LNG Sterling Corporate Bond Index returning 0.63%. A large reason for this is that the Federal Reserve and the Bank of England have put out some slightly more bearish than anticipated commentaries associated with the interest rate rises. Last week, with the Federal Reserve Chair Powell stating that 0.75% step rises in their base rate is off the table, and fewer Bank of England committee members voted for 0.5% than 0.25% than at the previous meeting. Figures have shown this week that inflation is unfortunately proving to be less transitory than thought, and this has been reflected in our gold holdings, with iShares Global Gold EC returning 0.93%. Not surprisingly, our European holdings with Bailey Gifford have unfortunately been our worst performer for the week at minus 8.7%, with HSBC and MSCI China falling at minus 7.48%. China's been affected by continuing COVID restrictions, as I mentioned, which is causing concern with regards to their growth rate throughout the year before their conference at the end of the year, as well as it's started to inflict further pain into global supply chains. You may be surprised in the current environment to see that our third worst performing fund is iShares Global Clean Energy. This is in part due to the fact that clean energy investments are quite interest rate sensitive, and therefore the increasing rates have been affected. When looking at quarter-to-date performance, we see that our portfolios have returned between minus 3.81% and minus 9.07%, with 1 of the 10 portfolios outperforming benchmark. And this is a continuation of the themes discussed in the week today, as we continue to see headwinds within global markets. When we look at the full fund performance over this period, of course we see a continuation of the themes discussed previously, with inflation in gold resulting in iShares Physical Gold returning 2.25%, as well as there's been a theme throughout the year with a pivot from growth equities to dividend payers, meaning that our SSGA Dividend Aristocrats holdings have ended up being our best performer quarter to date at plus 2.45%. At the other end of the scale, again, we can see continuation of themes discussed previously, with European holdings struggling at minus 18.73% and minus 14.61% for the quarter to date, and iShares Global Clean Energy for the quarter at minus 13.4%.